Yeah, welcome. In this video, we are going to look at how to do a sniper entry with other blocks. Um, the instrument we are going to use is Volatility 50, a synthetic index from Deriv. We are going to look at from 24 hours time frame through 4 hours time frame, 1 hour time frame, then um, 15 minutes time frame to 5 minutes time frame to get our place where we can um, um, get our entry. So let's dive into it then. uh, if you look at the market has been ranging. This is a 4 hours time frame though. The market has been going from like this lower high, low. This is higher high, higher low, lower high, lower low, lower high. Then it did a higher low, then it did a lower high again, then it did a lower low, then it comes like this. So basically, if you look at our market here on a 24 hours time frame, this is high, this is bearish, then a retracement, because this is a higher high, higher low, this is a high, low, lower high, lower low. Then we expect that the market should retrace around this zone. Okay. Um, with that said, you look at this zone, you see that a lot of things has happened on is happening on this zone. A lot of thing is happening on that zone, on this zone. So you can say that there have been several touches on that very particular zone. There is a reaction here, there is a proper reaction on the zone here. There is another one here, there is another reaction here, and then there is this reaction here. There is that reaction there. So if you go down to a lower time frame, let's go down to 4 hours time frame, then we just increase it so that it can be legible. You can see that properly. There is the reaction at these zones as we speak. Then there is a double top here. There is a double top. So market here went down, rejected at that zone, went down, then it's rejecting here. This is a bearish candle. Let me just uh you can see on a 4 hours there are two bearish candles. This other one engulfed this other one, so there is a reversal pattern here. And even if we go down to 1 hour time frame, then you can see it very well. It has created an M pattern. If you increase, you can see that it has created an M pattern. So trying to go down like this, M pattern. So you can see it that there is an M pattern there. So what we are looking at is that as this market is approaching here at this candle, there are several things we can do. Since we know that the market has approached a previous point of interest. It has approached our point of interest. Okay. If I go down to 15 minutes time frame, if I go down to 15 minutes time frame, you will properly understand what I mean. Okay, this is our 15 minutes time frame. Um, I'm just going to like bring it down a bit, then push it up. Then this is our as oh no, okay. As the market is approaching here, you see that there is a push up, there is this push up, there is this push up. As this market is pushing up, and we see this candle, rejection candle here, what are we to do? You know, then the thing is that we have an order block here, an order block here. Then we can draw our order block there. This is our other block. Then we can just draw the other block here. Then what you can do is that if you draw such other block, you can create an alert and tell them, because there was the first rejection here at our zone point of interest. There's a rejection and the market went down. What we are looking at is that the market will come into this zone we have drawn so that we can just take the market down as well. Okay, so we can just put an alert. So when the market come here, as the market is approaching this other block, we can just come and really look at the market and then take note. But you see that there is a manipulation. The market came down. You have not even entered. You are just approaching it. So probably you entered somewhere around here, entered somewhere around here on this leg, and then uh, or probably if you are risk averse, you would have allowed to see a proper rejection, a proper rejection, so that because if you have taken the trade here, I don't know why somebody should take a trade, because there has not been a signal here, and then there is this push up, then push down, then a proper rejection here. This is a proper rejection, so probably you would have taken the trade here because it's still within the candle closed here. You would have taken the trade here. So because the first push, see this candle, rejection candle, then the second push, then it rejected, then you would have taken this trade here, go down, then your stop loss would have been somewhere here, somewhere above the high of this. You would have put your stop loss there, and then willing to take you would have done this, you would have done this here, then your stop loss would have been, I'm just trying to draw it properly so that you can get it. Your stop loss would have been somewhere here, your stop loss would have been somewhere here, then but where are we targeting, we go back to our higher time frame, you know uh higher time frame, maybe probably 4 hours. You look at 4 hours time frame, and then we look at where we are going to target. Our target could be here, here. That is our target. That is where we are targeting at the first instance, and you can target here at the second instance. But at the first instance, this will be our target. This here, that will be our target at the first instance. So, okay, so let's go back to a 15 minutes time frame so that you can see properly how huge that market is. You can see this is a 1 to 7, 1 to 7 risk reward, 1 to 7. So um you can see, if not, if we have not used this top down analysis to take this entry, although this entry can still be taken somewhere around here. The only thing is that it is not a sniper entry any longer, but we are in this video we are just talking about sniper entry, sniper entry. So that is just what we just did. So I hope you understand, you know, you know, you get value from this video. Thank you and happy trading.